Definitely holding its ground, threatening to break out to some new highs. It is still in a strong bull market phase. It's put in a correction phase. And this could pop and run and continue to extend. I think we have that 37.50 is our next measured move if this was to continue to go up. Right now it is still consolidating. Again, I think if the equities market starts to struggle more, we could see this really take off. I'm surprised gold isn't up more, to be honest, with what's kind of happened over the last couple of days. But anyway, it is holding its ground, still in an uptrend. Again, we're not long gold. We did play it for a bounce. We got out, locked in some profits. Long term, I do hold physical gold and silver. I believe they are going to continue to go up long term. They might go up in the short term here, but I do think they will have a correction. And if we do have a big correction and a financial reset, I'll be adding to my gold and silver stack for long term at that point. But right now, we're just kind of leaving it as is.
Gold remains in a strong bull market, currently consolidating and showing potential to break out toward the $3,750 level. Despite recent events, its price hasn't surged as much as expected, though it continues to hold its ground. Chris Vermeulen recently took profits from a short-term trade but still holds physical gold and silver for the long term, expecting them to rise further, mainly if a significant market correction or financial reset occurs. According to Reuters, amid escalating Middle East tensions, particularly U.S. strikes on Iran's nuclear sites, gold futures are in high demand, with analysts forecasting a possible rise to around $3,900 per ounce within 12 months. Chris Vermeulen also highlights that silver has been trending upward and recently caught up to gold's earlier gains, though it's now at the higher end of its range and may pull back. Silver is near $36, modestly up as safe haven flows counterbalance dollar strength. Gold miners are exhibiting volatility but remain in an uptrend, with the potential to continue moving higher amid global uncertainty. Oversold signals hint at possible rebounds. Crude oil, driven by recent news, has surged past key levels with heavy volume but remains volatile and unpredictable. Due to the risks associated with commodities like oil and gas, the speaker prefers trading highly liquid assets such as indices, bonds, and currencies for more stable performance. The S&P 500 recently dipped into oversold territory but remains in an uptrend, exhibiting volatility with sharp sell-offs and rebounds. The S&P 500 rebounded modestly to around 6,012, up roughly 0.75% following indications of a restrained response from Iran and dovish tones from the Federal Reserve. Traders are reacting emotionally, often buying at highs and selling at lows, while the market consolidates and waits for direction. The Nasdaq shows a similar pattern, having hit key profit targets. Meanwhile, bonds remain weak and unattractive, still in a downtrend. The US dollar, though widely disliked, is showing signs of a potential rebound from a double bottom and could rally strongly, especially if recession fears grow. The speaker emphasizes trading based on price action, not emotion. Watch the video for more details and don't forget to like and subscribe for updates.
If we take a look over at crude oil, actually, you know what? I'll look at silver just because many of you trade silver. Let's zoom out on the silver chart a little bit here. Silver, it does have a fairly decent looking chart, more or less. It's channeling to the upside. I would say it's at the upper end of its range. It could very easily pull back and consolidate or something from here. Again, not that interested in the space too much, but silver's definitely come to life. Gold has been kind of trading sideways while silver played catch up. That's what I tend to see. We see gold move first and then silver plays catch up, and that's kind of happened at this point. Based on my analysis and just for the short-term analysis. So I think the market's kind of going to take a bit of a breather. If we take a look at the equities markets for the miners, they are pushing up. They're showing increased volatility. We do have a big pop, another push higher, sharp drop, a big move up, pull back. It's trying to figure out what it is trying to do. Obviously, you could argue here it is, holding its ground and it could continue to extend. If we have more uncertainty, more war stuff, maybe gold takes off and silver and miners shoot higher with it. Again, it is in back into an uptrend and it is moving higher. So it is definitely a sector that can be held or long at this point if you want a discretionary type of trade or if that's your main focus. You can see here on the 30-minute chart we have seen, let me just pull this over a bit here. You can see we've dipped into these oversold territories for miners. When the market gets oversold, we tend to see the market have a bounce. Again, we're getting close to the 20-day as well, so we could start to see a bounce here. Again, this oversold and overbought market conditions, which won't show here, they show in a downtrend. along with the panic selling lows for the stock market and the FOMO indicators, which we can see more or less when we come to the stock market, when we zoom in on these charts. This is where we see these panic sell-offs. We see the FOMO, which the FOMO is this red indicator, panic selling. We have FOMO, and then we have, we got panic FOMO right here, and then the market sold off. All this is in our book, The Technical Trading Mastery, which is on our website or Amazon. If you want to learn how to set up these little charts, so you can work on any charting platform. It's just a simple calculation to get these ratios and turn them into line charts and overbought, oversold conditions. Let's go take a look over at crude really quick. Crude oil definitely screaming higher. Obviously, war stuff tends to send gold and oil higher, and we've definitely seen that. So it has kind of regained that 65, 66 level. Massive volume, some big selling volume. Again, this is a news-driven move, and definitely throws kind of a wild card into things. In the grand scheme of things, series of lower highs, a series of lower lows, news-driven move. All this stuff makes things very uncertain. I don't really trade oil too much anymore at all, nor natural gas. I kind of stick with what I'm really good at, which are the indices, bonds, currency, and they're super liquid. And we don't have to worry about as much craziness as some of these other sectors and commodities have in terms of risk. As soon as you get this type of stuff, it carries a lot of risk. And risk is what we want to avoid and try and keep to a minimum. In our investments. Bottoming pattern. If we take a look at the S&P 500, we did dip into an oversold territory within an uptrend 2 trading sessions ago. Again, we had a big gap down into oversold into the 20-day moving average, and then we saw a huge gap up. And as we know, gaps tend to get filled, so it faded back down, filled most of that gap. We've kind of been ping-ponging around between some short-term oversold panic sell-offs, where we see the market dip into these oversold little panic areas. We've seen short-term FOMO where everybody piles in and then the market goes the opposite direction. They all buy near the highs. We saw that right over here at the open on the last trading session. People piled in and then they got left behind, or not left behind, but under pressure. And then the gap down this morning is probably going to spook them out. We might see panic selling, and the people literally who got long right up here a session ago, it will be, potentially exiting down at a lower level, and then hopefully the market rallies. Now the trend is still to the upside. I like this type of pattern when we have news-driven move and we see the markets open lower and then start to rally and take off. Up with the stock market, get out. We avoided the market crash. We got back in. We've hit a target with the S&P 500. We still remain long. If we take a look at the NASDAQ, very similar. We got out of this. We avoided the big crash. We're back in. We've hit our first target. We've hit our second target at 10%. And again, the market really is just kind of consolidating, trying to figure out if it is going to have another push higher towards our next target, or if it is going to stall out and roll over. Nobody knows what the market's going to do. All we can do is follow it as close as we can with the best tools and edges that we can scrape out of the markets and manage positions. And that is it in a nutshell. If we go and we take a look at a few other assets, what else is happening here? If we take a look at the bond market, we do have bonds. I saw an article yesterday, on the headline news saying bonds are back. They've been going up for a while. And I look at the chart, and to me, this is a terrible looking chart. This maybe it's trying to carve out a little bit of a bottom here, but in a nutshell, this is kind of a bearish pattern before it could potentially fall again. So we'll just have to see. When you look at the big picture of bonds, we're not that excited about it. It is in a bear market. At best, it is at a stage 1 base trying to carve out a bottom. But again, it's making a series of overall lower highs, lower lows. It just doesn't look all that good at this point. So again, we're still steering clear of bonds and just letting them work themselves out. If we take a look over at the dollar this morning, we are seeing the dollar up fairly nicely this morning, up 0.6%. Again, the dollar is trying to recover from the tariffs. All that news, it really unwound from that position, and now it's trying to figure out if it's going to put in a bottom. A few interesting things. We do have some pretty massive volume. We do have some, not a huge volume, but it feels kind of like a double bottom here. The fact that we had huge volume down at this phase. I feel like it's trying to carve out a bottom. I think the tariff side has been kind of worked out of the price at this point. And of course, everyone hates the dollar and everybody's avoiding the US, it seems. And typically that is a sign of a turning point. When something's most hated, that's usually when it starts to come back to life for one more scare, like in a scary movie. The dead always comes back for one more big move. So I do believe in the long term. Now, this is just obviously a gut feeling, and based on long-term charts, I do believe the dollar will eventually have a very big recovery and could actually have a significant rally. Now, it goes against, fundamentals. It goes against what a lot of people think and feel, which is probably one of the reasons why I actually like it. In a nutshell, the dollar is trending and channeling to the upside. It's at the lower end of its channel. It's most hated. And if we do go into recession, the economy and the world kind of struggles, the dollar tends to perform pretty well. So that's we'll see how that unfolds. Again, we don't trade what I think, we trade what the charts are doing. And that is the significant difference between successful traders and not. We don't trade off emotions, what we think and feel. We trade off price action and manage.
Chris Vermeulen exposes that Bitcoin recently pulled back slightly after a strong rally and is now forming a bullish flag pattern, suggesting potential for another breakout. Bitcoin recently dipped below $99,000 amid global risk-off sentiment, then regained ground to trade between $101,000 and $103,000. The current trading range is $98,000 to $104,000. The speaker remains long on Bitcoin, utilizing their ban strategy, with profits locked in and no emotional trading. They emphasize ignoring news and outside opinions, focusing solely on price action and patterns. In contrast, the real estate market appears bearish, characterized by lower highs and extreme volatility. The speaker anticipates a significant housing market correction within the next 6 to 12 months, similar to past bubbles, presenting future buying opportunities when prices and cash flow become more favorable again. Now let's dive into the interview.
Let's take a quick look at Bitcoin. Bitcoin has been pulling back a little bit here. As we can see with Bitcoin, it's had a very nice run in recovery. We saw this huge exhaustion gap we talked about. We've played to the long side. We've hit our target. We continue to be long with our band strategy. It does have a bull flag or pennant formation through here, pointing to potentially another big run to the upside. So this is kind of a free trade. We've been on this with our band strategy, BAN, and really just letting it mature. We've hit our targets. We've got our stop in the money or at the money. So no matter what, it's a small win. If it does shoot higher, then it's going to turn into a big win. So I like these type of setups. It's the same with our index trades over here. We're deep in the money. We just have to let them play out. Let the market do what it's going to do. Don't get caught up in the news. Don't get caught up in emotions and other people's opinions. This is one thing that I did a long time ago is I stopped listening to the news over 10 years ago. My kids fill me in if there's something earth-shattering, or my wife. But I really just don't pay attention. I don't read other people's analysis. It's super easy to get to second guess yourself. You really do need to pick something or a strategy that makes sense to you, follow it, and don't get sucked in. I can paint a bullish or bearish picture for pretty much any chart we look at. And everybody does, and to their bias. What I do with my analysis is I always share what the charts are showing, whether we like it or not. I just show what the charts are showing. But other people have scenarios in place that they try to they'll throw you off your game, and they'll weave in fundamental data and scams and stuff going on that'll make you feel like it's worth listening to. But really, the key is just to follow price and to just not have a bias. Just look at the price. Is it trending up? Does it have a bullish pattern? Where is it pointing to? Use Fibonacci extensions or retracements for levels and manage positions from there. Let's take a quick look. I think this is kind of last asset class. Let's take a look at real estate real quick. When we look at IYR, the real estate trust, obviously a series of lower highs, lower lows, definitely has some extreme volatility. This looks pretty bearish still, in my opinion. The housing market, I think, is going to really give way, and we're going to see a much bigger collapse over the next 6, 8, 12 months or even longer. The housing market is fairly slow to unwind. So I think we're going to see a big correction. I remember, if we take a look at Miami here, but it's a lot similar to this in a lot of other places. So my family has a couple of places in Florida. And I remember this housing bubble. I remember my parents looking at a house for $550,000 right by the water in Florida. And my parents ended up picking it up for 200 grand a few years later, the exact house they wanted. And so this goes to show you where we had the housing bubble and then the bust. We have another housing bubble, and I believe we're coming into a big bust. Now, not all cities are going to correct, 50+%, but there are going to be some huge corrections. We haven't really, all we've seen is the top foam or just the top of the market fizzle out a little bit. We haven't seen the collapse yet in the markets. And we're going to see, I think, huge reset, which is going to be a great opportunity for anybody getting into real estate down the road, where the numbers actually make sense. It becomes a viable investment, and you can make money every month and make money year after year versus trying to cover your costs or having a cash flow negative property. So I think we're coming into something very, very big in terms of the real estate space. And that's something, obviously, I keep my eyes on and keep you guys updated with.
Chris maintains a disciplined, emotion-free approach to trading, relying strictly on price action and chart signals. With markets exhibiting increasing volatility and signs of potential reversals or breakouts, he emphasizes the importance of remaining agile and risk-aware. Investors should be prepared for significant opportunities, especially if a financial reset, real estate collapse, or renewed surge in hard assets unfolds. Do you think gold will break above $3,750 in the next wave of market uncertainty? Is the housing market on the edge of another 2008-style correction? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.